Ever watched the market fake you out just when you thought the breakout was guaranteed? Well, that was a total soap. One of the brutal ways the market hunts impatient traders. And if you cannot seem to understand the candle range theory, then you, my friend, are the turtle on the menu. But what if I told you that there's a way to flip the game, to spot these traps before they happen and turn them into your biggest edge? Now, this video isn't just another candlestick pattern guide. This is a complete ultimate full course on candle range theory where you'll learn exactly how to trade both trending and ranging markets, decode false breakout, and profit from the chaos that most traders fear. In fact, this video is supposed to be a VIP content for my VIP students, but due to the high rate of demand that we've been getting from people trying to get enlightened more on the candle range theory, we decided to air it out to the public. So we are covering it all from the core psychology of ranges in candles to advanced total soap setup to exact entries, stops, and even profit targets. So if you're serious about mastering the market, you need this. And each and everything I say, do not skip a single step because each and everything links to each other. Each and every word I say links to each other. So stay to the end, and by the final lesson, you will never see a candle the same way again. So in this video, we'll talk about a lot of things. We are going to talk about, first of all, what a candle range is. Right? Then I'm going to talk about the importance of candle range in identifying structure. Okay, identifying market structure, and then I'm going to also tell you on which market the candle range theory works best, because most traders just learn a strategy but they fail, or they are going to fail to learn on which market does that strategy actually work. There's trending market, there's ranging market. So if you learn let's say for instance you learn reversal strategies, and then you're using reversal strategies on ranging market, you're going to keep getting stopped out because the market is not trending up or down. And your strategy only works perfectly on markets that are trending either up or down. And you'll think you have a problem. No, it's not the problem. It's because you're not following the strategy or the rules concerned or attached to that strategy, right? And we're also going to talk about the second candle. This is what I'm talking about. The second candle. This is the ranging candle right here. Okay, and this is the second candle. Okay, so we're going to talk about the second candle, which is the candle that makes the turtle soup. The candle that makes that long wick at the top or at the bottom, because a turtle soup can occur at the top or at the bottom. So the candle that makes the turtle soup. Don't worry, I'll tell you what a turtle soup is. Then we're also going to talk about the types of turtle soups that we have. Okay. Then we'll talk about additional confirmation filters like the volume or 20 period moving average or Bollinger Band that we can align or attach to this strategy as a whole to further confirm our entries and exits. Okay, and then we'll talk about common mistakes that traders make, like trading turtle soup candle range theory without confirming the entry or the direction of the market on higher time frames, or ignoring higher time frames and usually using only one time frame for both analysis and entry, which is very inaccurate. And I'm also going to talk about the importance of backtesting and journaling. Then I'll show you my 5-day trading win rates so that you can see how strong this strategy works. Then we'll talk about the psychological aspect of trading, not only on this candle range theory but on other strategies. So it's going to be a bit lengthy, but if you're really serious about improving your overall trading knowledge, I assure you that the time you're going to spend will be worth it. So back to our first topic. What is a candle range? What is a candle range? A candle range is the total price movement of a candle. It is the total price movement of a single candlestick in a trading chart. Okay, so this is a single candlestick. This one is also a single candlestick, and this one is also a single candlestick. So they say a candle range is the total price movement of a single, not multiple, of a single candlestick in a chart, right? That means we are talking about just one candlestick, right? So in this case, let's just use this white candlestick right here, this one. Okay, so candle range is the total movement of this candlestick from its low to its high. That is just what it means. The total price movement from its low to its high completely. That is what candle range theory means, right? That is what candle range is. The range that this candle went when it is being printed or when it was printed, okay? And we have a bullish candle range and we also have a bearish candle range, which I'm going to explain to you what it actually means. So on a bullish scenario, like this candle we're talking about, this white candle that we are still talking about, if the candle wants to get formed, it obeys a rule that is the OLCH, right, which is the open, right, the open, low, high, close, because it is a bullish candle. First of all, it opens, it first of all opens right here, okay? After opening, it then goes low to manipulate the market, and then it moves high to distribute the market, and then closes. That is open, high, open, low, high, close. While on a bearish scenario like this, I'm really sorry, on a bearish scenario like this, okay, it obeys a structure called the open, high, low, close, because it is bearish. First of all, what it does is that it opens, the candle opens right here, because on a bearish scenario the candles always open at the top, right, not at the bottom. So it opens here and then moves high to manipulate price, then goes low to distribute the price, and then closes. All right, so take for instance this candle right here, this white candle, this one is a 4-hour candle. So what you're going to see on the 4-hour candle is just one long candlestick like this. Okay, let me make it green so that it will be more comprehensive for you. So a bullish candle on a 4-hour time frame looks like this, right? So this is a full green candle of a 4-hour on a 4-hour time frame. So if you want to view this same candle, this same 4-hour candle on a 15 minutes, what you are going to see are a series of candles. First of all, it is going to open here, okay? The candle is going to open here, and then it will accumulate price. After accumulating price, it will then manipulate to take the stops of traders and then move to the upside. This dash I'm showing you are all candlesticks that formed within 15 minutes. It goes to distribute the price and then comes back and then closes like this. So what this actually shows is that one candlestick on the 4-hour time frame is a series of multiple candlesticks on the 15-minute time frame. I hope you're understanding what we are talking about here. So it first of all accumulates, all right? It follows a law called the AMD. It accumulates. After accumulating, it then manipulates and then begins to distribute price to its original level. Then it comes back and then close, something like this. That is what you're going to be seeing on the 15-minute time frame. Okay, same applies to the bearish candlestick. So if on the bearish scenario a candle opens like this, okay, a candle opens like this. This is a 4-hour candlestick. This is a 4-hour candlestick. So on the 15 minutes, what you're going to see is an open here that results into a accumulation, and then the price will then manipulate to make a low and then begin to distribute the price to the original direction. But in this case, since we are talking about a bearish scenario, we are not going to open the candle just like I did right here. Okay, the open is going to be at the top, because on a bearish scenario the open is always at the top, while on a bullish scenario the open is at the bottom because it opens and then go up, while the bearish candle opens at the top and then come down. Okay, so what we are going to do is we are going to open here, then accumulate price, then price will then tend to manipulate to take out stops. That is where the smart money gets in, and then price will begin to distribute to the downside like this, and then it will make a low and then close, something like this. So this is what you're going to see on the 15 minutes. Now this is what I'm talking about. So take for instance, this is a 4-hour candlestick, right? This is a 4-hour candlestick, and these are the 15 minutes candlestick. So this is the relation between a 4-hour and a 15 minutes candlestick. When the price opens on a 4-hour, just like this from this side, you're going to see that on the 15 minutes, the price is going to actually accumulate just like it's doing right here. After that, it's going to then manipulate. Okay, it's going to manipulate. Now this is how the manipulation looks like. So all you're going to see on the 4-hour time frame is a wick. All right, all you're going to see is a wick, but on the 15 minutes a lot is actually going on. It's a series of red candle or bearish candles that are being formed, trying to take the stop loss of traders. All right, so when they take that stops, that is when they are going to actually that's when the smart money are going to enter to distribute the price to the level or to the actual direction that the market wants to go, okay, which is the bullish direction. Now, this is how the distribution phase looks like on the 15 minutes and on the 4-hour. So the body of the candle, which is from this place, okay, down to this place, this is where the distribution occurs, and this is how you are going to see it on a 15 minutes time frame. Okay, after taking the stops, the candle or the chart will then go to its original direction. Now this is let me show you something. This is the accumulation, all right, then this is the manipulation, and then this is the distribution. Okay, all candles respect this, whether it's a full candle or a shooting star, a morning star, hammer, doji, bearish, ceramic, bullish, engulf, anything. All candles have a range. All right, all candles have a range. So we use the range of higher time frames to actually see the market direction, and then use the range of lower time frame to see our entries. Okay, so I hope we have understood the accumulation, manipulation, distribution, and the open, low, high close in a bullish scenario, and then the open, high, low close in a bearish scenario. Now we are going to enter into the second topic, which is what are the importance of candle range in identifying market structure. But before that, what is market structure? So market structure is the framework of price movement showing buyers and sellers how they interact. So it's usually formed an uptrend or downtrend or sideways trend. So market structure is just candlesticks. What is happening? Who are in control? Is it the buyers? Is it the sellers? So that control that is being shared or given to buyers or sellers from something called uptrend or downtrend. An uptrend is when more bullish candles or when more green candles are being formed, tending for the market to go to the upside, right, to grab liquidity. While a downtrend is when more bearish candles or red candles, or when sellers get into the market and they are in control. So they tend to actually drag the price down. So that's where a bearish scenario occurs, and then they grab liquidity and then move to the supply zone. Okay, while a choppy market or a sideways trend is when there's indecision in the market, neither buyers nor sellers want to take control. So you're going to see the market just going on a sideways direction. So we identify market structure on an uptrend when the market is making higher lows and higher highs. Let me show you what I'm talking about. So like I mentioned, we identify an uptrend in a market when the market keeps making higher highs and higher lows. So what higher highs and higher lows typically means is that the market moves high, okay, higher than the previous high, which is this high over here, and then it comes back and make a low that is higher than the previous low, and then it makes another high that is higher than this previous high, making a break of structure, then makes another low right here that is lower, that is higher than the previous low. Okay, so if the market is making higher highs and higher lows, then it is indicating that the price is going up. Likewise, we identify a downtrend if the market is making lower highs, lower than the previous high, and lower lows. All right, lower than the previous low, lower highs, lower low, lower highs, lower low. Then when this happens, or when this occurs, we then know, or we can confirm that the market is going to a bearish direction. We cannot disrespect this law until we see that the market changes its character. There's something called market structure shift. That means the structure of the market has shifted from making lower highs, lower lows, now to making a new higher high. All right, so as you can see, the new high now, okay, the new high is higher than the previous high. This is a market structure shift, change in market direction. So from this point onward, if the market makes another higher low, higher than the previous low, we can then say that the market wants to go on a bearish, on a bullish scenario. Okay, so one of the importance of the question we are actually answering is, what are the importance of candle range theory in the market, right? So one of the importance is that candle range theory identifies the strength of a trend. Yes, stronger trends signal continuation, and weaker trend signal possible reversal. Let me explain what I mean. So a stronger trend can be identified, all right, if the wick of the green candle, if it's an uptrend, if the wick of this green candle is touching the body of the next candle that wants to form, not the wick. All right, so if it's a wick to body contact, then it is then believed, all right, then we have strong probability that the next candle that will form, take for instance, this is a daily candle, a daily time frame, a 1 day time frame candlestick. So each candle over here represents 1 day of buying and selling, right? So this was yesterday's candle, for instance. This was yesterday's candle, all right, and this is today's candle. So if yesterday's candlestick right here, if this wick right here is touching this body, not the wick, then it is believed that tomorrow's candle or tomorrow's price will equally be a green candle like it is right now or right here, right? So let's put this in a real life situation so that you will get to understand what we mean. Now imagine that this candle is representing the price of 100 kg bag of cement. So yesterday, this is yesterday. Let's label it. This is yesterday, this is today. Okay, now let's assume that tomorrow has not occurred yet. So the current bag of cement, or yesterday's price of cement, was 100 USDT, or sorry, $100. Okay, $100. That is what the closing price of yesterday's bag of cement, 100 kg bag of cement is. And then we opened the market today. Okay, we opened the market today, and then in the evening time the price closed at $150, right? So there's an increment from yesterday till today. This is a sign that tomorrow's price might probably be higher than yesterday or than today's price, okay, due to the fact that there's an increment of $50. So what people are going to do is that when the market opens, we know that the big money, okay, the distributors and the wholesalers will tend to break down the price so that there will be lesser sellers in the market. Sellers will panic, and if sellers panic, those that have bought 150, those that have bought the price at $150, they will panic and then be at a loss. They will sell the bag of cement over here. Okay, they will sell it over here at 120 US dollar, losing $30. That means they have took their stops. All right, the market has manipulated them, or the big money has manipulated them. Then those big money that are now few in number will then increase their price to $200, and people will buy because they have already took out other sellers that have panicked. Right, this is the fake out I was telling you about. Other sellers have panicked, thinking that the price wants to go down, and they just sold their assets and then leaving the big money, and the big money will then start selling their assets at $200 tomorrow. Okay, now this is how we can be able to predict, or this is how we can be able to use candle range theory to identify market structure. Same applies on a bearish scenario. So imagine if the price of bag of cement is going down. It went down yesterday. Okay, the price went down from $200 to $150. Okay, so we are going to insinuate that since the wick of yesterday's candle is touching the body of today's candle, then that means there's going to be a possible continuation, and the price might probably hit $100. Okay, the price might probably hit $100 tomorrow. Even if it were to go back up, it would first of all respect this movement of sellers and then hit this $100 before it actually goes up, right? So what if in a situation whereby the price freaks people out? Let me show you what I'm talking about. This is where the candle range theory occurs. This is where the candle range theory occurs. Now, take for instance, you have a bullish scenario yesterday. Okay, price was up yesterday, and then the price began to go up today like this. It went up and then faked out and then brought back the price down, leaving a wick. This is the second candle that we are going to talk about later in this video. Okay, this is where the candle range power of 3 works. So this is the accumulation phase, right, which was yesterday. This is the manipulation phase, taking out sellers. All right, and then this is the distribution phase, making price to go down. It is as simple as that. Okay, it is as simple as that. If you notice, you're going to see that the wick of this candle, okay, the wick of yesterday's candle is touching the body. Sorry, the body of yesterday's candle is touching the wick of today's candle. Okay, this is yesterday. This is today, and this will be tomorrow. So if the body of yesterday's candle, if the wick of yesterday's candle is touching the wick of today's candle, sorry, I keep making that mistake. If the wick of yesterday's candle is touching the wick of today's candle, which is a wick to wick contact, then it means that there is going to be a reversal. So typically what this means is that wick to wick equal to reversal. Let me indicate it. Wick to wick equal to reversal. Okay, then wick to body equal to continuation. That is just it. So the wick of this candle is touching the wick of today's candle, meaning that the market wants to reverse. That means buyers took the price up, they continue to take the price up, and then sellers came and suppressed the price. That means sellers have come with full force. Then we are expecting that tomorrow's price is going to keep going down, because the sellers will actually tend to take out this liquidity that is resting over here. All right, after they've took this liquidity out, then the price might continue to actually go to its actual direction that it is supposed to go. All right, now let's talk about the second candlestick, which is this middle candle right here. We won't waste much time on this because we have already explained how it works. Okay, let's talk about this second candle right here. Now the second candle is also known as the candle that makes the fake out, or the turtle soup. So what turtle soup means is that, have you seen this wick right here, this wick right here? So whenever another candlestick comes in, okay, whenever another candlestick comes in, like this candlestick over here, and then makes a high just like this, taking out the liquidity that is resting here, okay, that means the wick of this second candle has already took out the liquidity that is resting over here. Okay, then that means it has souped this candle over here. It has souped this candle over here. Now, before showing you additional indicators and so on and so forth, let's talk about the bullish and bearish turtle soup. So this screen you're seeing right here, this chart you're seeing on the screen, is the bearish turtle soup. Okay, is the bearish turtle soup, because price is tending to go down. The bullish turtle soup is where the price, or where the market, makes a hammer. Let's see if we can find an image for that. Now this is the two scenarios. Okay, as you can see, this is the first candle, okay, and then this is the second candle that makes the turtle soup. So if you notice, you're going to see that the wick, okay, the wick of this first candle over here has gotten turtle souped. Okay, it has got turtle souped by this second candle over here, taking out the liquidity that is resting here. So if it has took out the if it has took out the liquidity resting over here, the next thing is that the price is going to get attracted to the liquidity that is resting here. So the next candle that is going to form, which is this one, will not stop until it takes out the liquidity, the money that is over here. So on this is a higher time frame. Okay, this is a higher time frame. What you're going to see on the lower time frame is series of upward movement. Okay, upward movement, and then liquidity grab. Okay, another liquidity grab, and then the price starts going down to take out this liquidity over here, then to grab this liquidity. That is just what the market is doing. It's being attracted from one side of liquidity to the other side of liquidity, one side of liquidity to the other side of liquidity. Okay, I hope you have understood this concept. Now let's go to the bearish and the bullish scenario, or the bullish turtle soup. So if the market was on a bearish sentiment, okay, which in this case, let's say this is the first candle is a bearish candle, then another candle forming a hammer or a dragonfly or a doji, okay, just like this, okay, forming this type of T-shaped candle, taking out the liquidity that is resting below here. Okay, so as you can see, the wick went down and turtle souped this place right here. It has took the liquidity that is over here. Okay, so the next thing is for the next candle over here to take the liquidity that is resting over here. So it will just go up and take the liquidity that is resting over here, and that's how the cycle continues to go. Okay, so this is the higher time frame. Whatever you want to do, use the higher time frame to check this pattern, then go to the lower time frame to look for entry signals. So before showing you additional indicators that can be combined to form the or to confirm the strength of the strategy, let me first of all show you my personal setup that I'm using. Okay, so this is a daily time frame. Okay, this is a daily time frame on Solana. Okay, Solana USDT. This is the 1 day time frame. So what happened here is that I have spotted a bullish movement candlestick, okay, a bullish uptrend candlestick, and then I saw that the candlestick, or this candlestick here, has got turtle souped by this other candle that has formed, okay, the next day. Okay, so since this is a daily candlestick, each and every candle over here represents 1 day of activity. So since it has gotten turtle souped by this candle like this, I'm expecting that the next day's price is going to actually go down to take the liquidity that is resting over here. Okay, now what I'm going to do is just I'm going to draw a line. Okay, I'm going to draw a line at the low of this place like this. Let me clear all this. Right, so I'm going to draw a line at the low of this candle, this yesterday's candle, and then draw another line at the high. Draw another line at the high like this. Then the next line I'm going to draw is at the low of this today's candle, just like this. So I'm not going to enter into tomorrow's trade, even if tomorrow's trade is red. Okay, even if tomorrow's trade is red, as long as tomorrow's trade, or as long as tomorrow's price does not break below the low of this price, okay, it doesn't break below the low of this price, I am not going to enter. Now this is where most people make mistake. As long as they see this pattern, as long as just they see this pattern like this, they'll just enter the market, and before you know, sometimes buyers will just come and take over the price, and tomorrow's candle will just, you know, go to the upside. So I have to confirm that the price that yesterday that was left yesterday has got broken, and I have to confirm that only on the 15 minutes time frame, since I'm using on the 15 minutes or on the 30 minutes. Since I'm using a higher time frame like the daily, then that means I'm going to use 15 minutes to confirm my entry. So all I'm going to do now is to draw a line. Let me draw the line. So this line is going to be my guide. Okay, this line is going to be my guide on the 15 minutes, so I can know what I'm doing on the 15 minutes, or I can know where to start from on the 15 minutes. So I'm going to use the Bollinger Band and the indicator. I'm going to show you how you can be able to use it to confirm that price wants to actually go down. Now let's head over to the 15 minutes, since we are currently on the 1 day time frame. So this is how the price is going to look like on the 15 minutes. This is how the lines are going to look like on the 15 minutes. Now this is the upper line. Okay, this is the upper line, right? This is the line that we want the price to actually break, and this is the place where the liquidity is, right? This is where we want our target to be. Okay, I hope you're following. Now let's turn on the Bollinger Band. Now our Bollinger Band is turned on. The Bollinger Band is these 3 lines right here. Okay, it's a technical analysis indicator. If you don't know how to use the Bollinger Band, do talk to me on my WhatsApp link in the description below, and get enrolled in my mastery class, where you're going to see more of this kind of comprehensive videos over there, right? So after you've turned on the Bollinger Band, before entering, you need to make sure that the line, which is the moving average line, which is this line over here, the middle line, the price, the current price right now, you need to make sure that it is below this line. Okay, the price should be below this middle line right here, the moving average of period 20. Okay, so now let's see how this plays out. All we want to do now is we want the price, or we want this price to actually break this red line. That is where our entry is going to be. Okay, now let's see how it plays out. We are not going to enter the market until the line got broken. Okay, until the line gets broken. So the chart has started. Now this is where patience works. Okay, some people, if they see that the market or that CRT has formed, they'll just rush and enter, and maybe place their stop loss somewhere that will just get taken out. So you have to patiently wait for the setup to happen. You cannot trade against the market. Okay, we are about to enter the red zone, and as you can see, the market is just playing with our emotions. This is where patience works. You just have to be patient until the market, until the price hits that lower band, or this red line that we have predicted that it must hit before we enter our trade. Okay, so it has hit, but it's just a wick. We have to let the body to get in, right? We have to let the body to actually get in. Now the body has got in, right? The body has got in. Now that we have confirmed that the body has got in, this is the line that we have drawn, and this is where the price is currently. And the Bollinger Band, the middle line is above the price. Okay, the price is below this middle line. Okay, this is the price and this is the middle line. Okay, and we need to actually see if there's any other confirmation that confirms the entry of this signal. It will keep going down. This is a head and shoulder pattern, guys. Let me show you. This right here is a head and shoulder. This is the first shoulder, this is the head, this is another shoulder. And if you're in our VIP class, you're going to know that whenever you spot a head and shoulder pattern, okay, that means the market makes a shoulder, then makes a head, then makes another shoulder like this, then it's just going to retest like this and then keep going down. Now this is the head, like I've shown you. Sorry, this is the left shoulder, this is the head, this is the right shoulder, and then this is the neckline. Okay, this is the neckline, then this is the retest, guys. This is the retest, okay, which is this place over here, and then it will keep going down. We have confirmed that this market wants to continue to go down. The next thing we are left to do is to enter at any given moment. So let's just enter the trade and see how it goes. So I have placed my stop loss to be just above the Bollinger Band and the middle band of the Bollinger, and then my take profit at 146. Remember, this is one of the places where traders do actually miss their trade. They'll place a very tight stop loss, right? A very, very tight stop loss. Some traders place their stop loss somewhere here, right? Just somewhere here. And the market will tend to just, play a little bit before it hits their TP, and it will just top them out and then go to the direction, and they'll think that the strategy is not working or something is wrong with them. No, you have to put a decent amount of stop loss and then a decent amount of take profit. Do not allow fear or greed to actually control you when placing a position. Right now, let's see how this plays out. So the market will continue to move, okay, and we'll see how it plays out, if it's going to hit our TP. Okay, so have you seen what I'm talking about? The market actually went up, and if you have placed your stop loss somewhere there, then the market will just top you out and continue to go to its previous direction. Let me make this a little bit faster. Okay, we just have to apply patience. All right, we just have to apply patience. So the market will actually tend to try to manipulate you until it finally reaches your TP level. And there you go, guys. We have took our profit. We have took our profit. So have you seen how the market played with our emotion, trying to make us think that the stop loss is actually going to hit? That is just how the market works, guys. That is just how the market works. But as time goes on, as long as we've seen all those indicators and so on and so forth, the probability of the market to actually hit our TP is higher than the probability that the markets will hit our stop loss. Right now, this is how we can be able to enter a trade, by using the higher time frame for direction and then the lower time frame for entry. So I also talked about the common mistake people make by not using that higher time frame, just using the lower time frame. Now let me ask you a question. If you use the lower time frame, or if you see that candle range theory on the lower time frame, where are you going to look for your entry? you cannot find an entry on another lower time frame, maybe the 1 minute or 5 minutes or 3 minutes, because those time frames are there are lots of noise on those time frame. You have to use the higher time frame for direction, since it has lesser noise, and then use the lower time frame for confirmation and then entry. Okay, now this is how you can be able to do it. Now let's quickly talk about the importance of backtesting. Okay, but before that, what is backtesting? So backtesting is referred to as the process of testing a trading strategy using historical market data, okay, to evaluate how well it will have performed in the past. We just backtested the strategy. Okay, so what backtesting typically means is that, let me go back to other price or to former price movements and see if I have applied this strategy that I've learned. If I have applied them in the past, will it have gone well? Will it have done what I wanted it to do? And if it didn't do that, what made it not to do that? You can use the trading view, but the case of trading view is that you have to apply for premium, or you have to subscribe for premium before they can open the slots or the interface for backtesting. Now the platform that I use is called gocharting.com. Gocharting.com. Okay, so you can use gocharting.com to actually backtest your strategies. Okay, so if you don't know how it's been spelled or how it's spelled, this is how it is. Okay, gocharting.com. So it allows you to backtest your strategy. Okay, so backtesting is a little bit easy. Okay, it makes you master your strategy. The problem is front testing. Okay, front testing is done not with strategy but with emotion and psychology, guys. Front testing is done with emotion and psychology, because when you are back testing, you are not using emotion, you are not using fear, you're not using greed or any other form of emotion, because you know that you are not using real money. But at a situation whereby you don't know what the future holds and you are using real money, that's where greed, that's where anger, sadness, fear comes in, and that's where traders tend to lose their money, even though they have actually backtested their strategy multiple times. So in order to backtest, you have to first of all have a strategy that you want to use. For instance, this reversal strategy. Then secondly, you have to backdate the chart. Okay, you have to backdate the chart to where you want it to go. Then apply the strategy to the historical chart. Then analyze the results. Okay, analyze the results and see your matrix. Okay, like the profit and loss, the risk to reward ratio, the percentage win rate, etc., etc. Now let me show you my 5 days win rate using this strategy. So we are currently on Bybit. Okay, I applied this strategy just yesterday when I spotted the reversal, the CRT reversal right here. Okay, as you can see, I spotted the turtle soup, and then I entered. I drew my line. Okay, and I waited for the price to actually go below this line over here, and then entered using the 4 hours. Okay, I used the 4 hours, and I took profits, right? I took profit right here, as you can see. Okay, I took profit right here. So let's quickly go to my trade and my P&L. Okay, so all I have to do is click on this place right here. Okay, so when you click on it, you're going to go to the P&L, the profits and loss. So by using this strategy, I normally trade BTC and Solana because of their high liquidity. Okay, so as you can see, there's a lot of win. So let's just go to the P&L right here. Okay, so this is where you're going to see my profit and loss percentage. So as you can see, I am currently on a profit. These green areas you're seeing are the profits that I'm taking. I'm using a small leverage to execute trades. Okay, so this is my profit and loss. As you can see, can you see the amount of greens are more than the amount of red, how it is? So let's check the trading performance right here. Okay, let's check the trading performance to see. You know, there's no way you can be able to make trades without having little loss in some days. Okay, there's no 100% guarantee strategy. So as you can see, this is the daily P&L. This is what I'm making daily because of the small leverage I'm using, and this is my total P&L within just 5 days, I think. Okay, so if you are going to go down, this is the percentage of loss that I have made. Okay, this is the percentage of loss, and this is the percentage of wins. I just made a $2 loss within 5 days and made a $23 win using this strategy. Okay, so as you can see, I switched my coin from Solana to SUI, and I made a mistake because I have not gotten used to using this SUI USDT. I'm only used to Solana USDT, and that is the reason why I could not be able to see the movement of the coin until I took my loss over there. So as you can see, this strategy has an 86% win rate. On just 7 orders, I was able to make, okay, on 7 trading orders, I was able to make 21 USDT. Now, what happens if I'm using $1,000? I'm just using $100. What happens if I'm using $1,000? Then this place will have been, this 21 over here will have been 210 USDT on just 7 trades that you can be able to execute in just 4 to 5 days. Okay, that is just how the strategy, that is the power of the strategy. You have to exercise patience and also be disciplined. Okay, be disciplined, know when to enter, when to go out. Don't get greedy. Okay, don't get greedy. Now I hope this video helps, and I hope you have a nice day.